Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show, and we're going to break it down into our normal 3 segments. Now it's going to be a little different, only because the Singapore refined product data and the Europe refined product data, they come out on Thursdays. So because we did the EIA show last week on Thursday, the data would be the same. So we just took that out just for the sake of time. And we replaced it with the OPEC new update in terms of where do they see supply, where do they see demand, because there's a lot of back and forth in terms of, well, is this really good? Is it overstating demand side? And I think there's a lot of things to unpack within that. So we really wanted to go through it. And then in segment 1, we want to just briefly look at on top, before we get into the deeper EIA data, what is happening on an economic level, because you're seeing a lot of pressure, you're seeing a lot of this economic slowdown, and for those that also watch the macro economy show, we go through a lot of this. So here we just want to have 2 important slides when you look at what kind of demand are we going to see. So when we break things down in the first segment, we're going to look at how there are builds across the board. What does it mean? How are things shifting? Then in segment 2, we're going to talk about how the demand, obviously refined product demand took a big nosedive, but again, there's also seasonality in that. So there will be a snapback. We just want to look at, well, where is it going to settle out? And we still believe that it'll be closer to about 9.1 million on the lower end. But again, we want to look at what does that mean, talking about obviously gasoline there, and then what is going to happen with the diesel market, because there continues to be a slowdown when you look at the trucking data, the shipping data. And then wrapping that up in segment 3, we're going to look at that OPEC demand expectations and how the shifting crude market is out there, because we are seeing this adjustment with Russian product, Russian oil really heading into the Middle East and into Asia, and how that's really shifting the market in general. To get into it right here, I think this is a really important chart and a really interesting chart when you look at the Philly Fed Manufacturing Index versus the non-gasoline demand. And again, like, gasoline demand is gasoline demand. Like, that's something that is specific, that is something that is going to be consumer driven. But when you look at diesel, when you look at natural gas, when you look at fuel oil, residual fuel, when you look at the things that are going into the industrial complex, it's really important. And again, like, when you look at the red line and black line, it's not like they match perfectly, but you can see they trend in the same direction. So when you look at the Philly Fed Manufacturing Index coming negative, as we talk about on the Econ show, we look at the regional Fed data, the national data, obviously all the different data sets. And one of the things that we've been talking about is a lot of those leading indicators, new export orders, new orders, CapEx expenditures are all in contractionary mode now, especially when you look out. So that's just going to pull down that diesel demand. That's going to pull down some of that other demand, which is what we've been saying. Again, none of this is surprising, because we can go back and forth on what we thought on oil price in general, but we've been very, very much spot on demand and where demand has been and how it was going to rise but be below, really not get back to that quote unquote normal 2019 level. And we want to look at, well, where is it going to go from here? And this is going to be one of those headwinds, especially when you look at diesel, because diesel pricing, and we'll have that slide in segment 2, continues to be a huge driver of inflation within the supply chain, because it adds up every single time that product is moved, whether it's raw materials, it's semi-finished product, the final product, it's all being moved by diesel, marine gas oil, and that's where it adds up, because diesel prices are not going down the same way as gasoline prices, which is what we have been saying from the beginning. When refiners try to make gasoline, they inherently make when they try to make diesel, they inherently make gasoline. So when you have a big shortfall and the crack spread supporting essentially even a negative gasoline crack, you're going to do as much diesel and create as much diesel as possible. And that's going to build up in terms of gasoline. You're going to continue to see that escalate. And as we've been saying, we are either at or near all-time highs on gasoline storage around the world, which is going to become a bigger and bigger problem. Now, another key component, and I think this is a really important one, And again, another reason why on the private equity side, we're buying hydroelectric dams, industrial electricity prices are going up. And you can see that they're staying higher. And the reason why we see that is because we don't see natural gas prices coming down. We don't see coal prices coming down. But we also don't see them going up much either, and that's the key piece. Like, and I'm sure you've seen the arguments of, oh, oil prices are going to $380. No, oil prices are going to $50. Well, why can't it just stay here? Why can't it just be range bound, just given the different shifts in terms of, there isn't all that much supply coming to market right away, but there is that demand problem. So you essentially have the two people staring across the room, and who's going to blink first? And right now we don't see all that much supply coming on. And we do see demand coming off, which again is going to cap where we are. And this is another key piece on the inflation problem, because even as you see gasoline prices coming down, that's going to help the consumer. They're going to feel better about their situation because they're not seeing their money just essentially drain away at the pump. But electricity prices are higher. Diesel prices are higher. These are things that are key input costs for everything that we buy, which is why, and we'll talk about this in the econ show, the inflation data was pretty bad. And the reason why we say that is because the sticky side, the core side, saw large increases. And the problem is the inflationary pressure was very broad-based. You can point to food, you can point to energy, but everything else is also moving, and all of that, and a large part of that, is being driven by these input costs that just aren't going down and we don't see adjusting. Now, as we pivot a bit further, Russia's huge exports of diesel. So as we know, Russia also exports a significant amount of diesel and fuel oil, and a large part of that was going into Europe and the U.S. But since Russia invaded Ukraine, things have shifted. So where are all of these exports going? And the answer is it's obviously going into Asia, but a lot of it's also going to the Middle East. So when you look at how things are shifting, the European Union is planning to set a set of urgent actions across the entire economy to mitigate the impact of a possible natural gas supply cut. But if you're cutting natural gas supply, then you're increasing coal and you have to increase your fuel oil. But, well, where is it coming from? And I think this is a really important piece. So most of the Middle East imports from Russia are fuel oil, which is obviously a leftover from the refining process and is used in power generation and shipping. So this is interesting now, because when you look at how things have pivoted in the Middle East, and we've been highlighting that the Middle East is sending a significant amount of diesel into Europe, and you might say, well, they normally have a higher power burn because it's obviously the middle of the desert. The air conditioners are going to be at full blast right now. So how are they doing it? Well, there's two ways that they're doing it. They've been adopting more natural gas. So they've been replacing some of their fuel oil, some of their diesel needs with natural gas. And they're also importing a significant amount of very discounted Russian product. So they'll burn the Russian product and export their product into the European markets, where they can get a massive collect a massive arb, which again also creates this backdrop, because Russia has to sell all this stuff at a discount. So then the Middle East is getting their product at a discount. So then they can turn around and sell their product that is created locally in their refiners at a significant premium, and they're collecting two arbs, which is obviously working in their favor. So the Middle East oil product imports from Russia last month reached the highest since at least the start of 2016. Well over a third went to the oil trading and storage hub of Fujairah, and the other of that also went into that power burn that we've been talking about. So now when you start looking at how this is shifting, you have to look at total oil products and stocks. So the deficit narrowed from 111 to 88.9. And this is what we've been talking about, is that when you look at the blue line, which is 2022, you're not seeing a huge step up. It's a very gradual rate of change, but it's shaking off the seasonal drop. And that's what we've been saying, is the comps are going to get easier. So one of the things that we've been saying is that oil product storage is going to be flat to slightly up. And that's going to shake off what should happen, which is why the comps get easier. When you look at crude stocks, land and floating, the deficit narrowed from 49.1 to 22.6. But again, look at that gray line, which comes down. Look at the 2021 line that comes down. We've just gone flat, and at this point, a lot of this is based on land because floating has seen a drop. But there's also a record amount of crude on the water, and that's between floating and crude in transit. There's a record amount of crude in transit, even against where we were in 2020, just given the amount of Russian crude, because we're increasing miles per ton, we're moving more around the world. So when you look at the deficit widened on the product side from 62.2 to 66.4, that's important because, again, that's middle distillate driven. We are seeing big builds in light distillate. Fuel oil, heavy disty is fairly flat. The big driver remains middle distillate because gasoline continues to build. Now, U.S. imports of European gasoline, they're the highest in 3 weeks. That's something that's going to show up next week in the data. But again, as we've been saying, Europe is trying to manage storage, but the ARB did close. So the question is, are we going to see more on the back of it where people are going to say, look, the ARB is going to widen out again. We're going to be a little proactive and get out there, but this is going to cap some of that flow in the near term. But again, we will get one more bump before we see some of those slowdowns. Now, when you look at land storage here, you can see that the deficit narrowed from 80.8 to 61.6, and that's going to continue to be the case based on what we saw in the U.S. today, as well as some of the things that we're seeing in terms of Europe and the other regions. Now, the ARA did have a drop, but again, it's fairly stable and stuck in this range. So, but when you look at, again, we're shaking off that natural drop. West of Suez, deficit narrowed from 63 to 44.1. East of Suez, the deficit narrowed from 22.3 to 20.5. Those things are going to continue to be the case, all the while European buyers continue to buy diesel from India and the Middle East. And again, it's even though Europe's not buying directly from Russia, they're indirectly buying because of Russia, because the Middle East is freeing up what can flow into the market. So when we look at floating storage, you can see that the surplus narrowed from 22 to 10.2. And again, that's all really being driven by a lot of that finally being pulled onto land. And that's why we've been saying that you have to look at the two of them together, because when everyone was pointing to land storage, we kept saying, but there's a lot sitting offshore and there's a big timing delay. There's these big problems in terms of these bottlenecks that as they start to alleviate, you're going to see this big swing, and that's going to drive some of this land storage. Floating storage west of Suez, deficit narrowed from 10 to 3.8. We continue to see some builds in both West Africa as well as the U.S. But again, those are things that we have been calling for. Where east of Suez, the surplus narrowed from 31.3 to 14.9, and that's because we did get a little bit more movement from the Middle East and more product being moved from the offshore side in Asia to the to onshore storage. It's still above where we were in 2021, but again, you're seeing some of that drop as you're getting some of this normalcy, but we're still getting a very limited amount of refining activity within China, which is causing a significant buildup in land storage. And that's going to slow down some of their purchases, which is going to leave some of this crude on the market, specifically in West Africa. So now when we turn to the U.S., you can see that we had a build of 3.25 million barrels. The build was really driven based on what happened in Pad 3 and Pad 5. Pad 3 had a build of 1.74 million. Again, that's just 4 million below the 5-year average. And then with the Pad 5 is just 2.9 million below the 5-year average with a build of 2.53. So Pad 2, Cushing, small builds, still at a very low rate. Pad 1 had a draw of just over 1 million barrels. That's 6 million below the 5-year. But again, it's all really being driven based on Pad 2, which is why we continue to see the Canadian imports remaining elevated. Once we factor in the SPR, you can see that there was a drop of 3.63 million. So again, it's just a matter of commercial versus SPR as we continue to sell into the market in general from the Strategic Petroleum Reserve. Crude oil production dropped 100,000 barrels. Again, this is just more semantics, just given the slowdown from 4th of July. We don't see it adjusting all that much. So again, you're going to get a snapback in that production going forward. And one of the key things that we want to factor in is we did a big report on refracs We have actually a cover story coming out in AOGR where we talk about how refracs are really starting to come into their own, and that's going to be a big driver as we go through the end of this year, but more importantly into 2023. Now, it's important to appreciate that refracs, again, depending on rock, depending on source, you can get oil as well, but it also has a fairly high liquids and natural gas cut. So when you start looking at some of this growth, which we're going to talk about in segment 3, the comment is on liquids growth, and we do see a decent amount of liquids growth coming into 2023 and not as much oil growth. And I think that big pivot's going to be important, especially because when you look at demand growth over the next decade, we've been saying that again, not to say that black oil demand is going to go down because we think it's fairly flat to slightly up, but liquids demand and condensate demand is going to be the biggest driver. And that's where we see the most growth when we look at, holistically speaking, oil demand, because oil demand, as we hear it, 100 million barrels a day. Again, the 100 million barrels a day, that's not all black oil. That's not all crude oil. There's a mixture in that with almost 40%, just over 40% being liquids, which is why it's such an important piece of the puzzle. Runs in the U.S. increased by 201,000 barrels a day. Again, essentially just bringing back what we saw from July 4th. So the utilization was up 0.4. Again, you could see it was in pad 3. So really nothing crazy when you look at where we are at this point in time. As you can see here on the utilization rate side, we're fairly normal for this time of year, kind of bumping along the averages. And now, but even though we have a normal utilization rate, it doesn't mean we have a normal flow-through rate because we've been shuttering refiners. So again, a 94%, 95% utilization rate isn't yielding the same because we're getting a utilization rate on a smaller pool, if you will, which is shifting that a bit. Imports came down 163,000 barrels a day. It was driven by pads 1 and 2, as well as 4, but 4 was fairly small. Pad 3 had an increase of 399,000 barrels a day. We continue to see it increasing as they're trying to take on a bit more West African crude, especially as prices have come down, and get some of that medium to heavier cut to try to, again, target that middle distillate side. Pad 5 remaining lumpy, but again, 69,000 barrels a day. You know, the biggest thing that we had called for was a small drop in Pad 2 and a small increase in Pad 3, or I should say a sizable increase in Pad 3. So we do think that there's more upside, but Pad 2 had set a record, so a small pullback was in the cards, and we see Pad 2 imports still remaining elevated. Here's when we look in Pad 3, as we said last week, we expect Pad 3 imports to take out the 2022 highs. Again, not getting back to the 5-year average, but still making new highs for 2022 as we bring in more crude from abroad. It's not a straight line. You'll see some movement up and down, but again, the trend is going to be up to as we take in additional product. Pad 2, as we said, was going to pull back a bit. So we're just going to stay at the very high end of this cloud as we continue to take in more crude from Canada. Now, implied demand obviously took a nosedive. The gasoline dropped 1.35 million barrels a day, went from 9.4 to just over 8 million. Distillate had a huge drop of just over 1 million barrels a day, went from 4.38 to 3.36. Again, and then jet fuel went from 1.8 to 1.36, so a drop of 437,000 barrels a day. There's a certain amount, as we were saying, and after July 4th, when you look at that reaction, you typically have this big surge forward. So you get that spike, and then you typically get a drop. Now, the drop can vary in size. Obviously, this one is sizable, but we still see an increase. We're not going to stay down here. We're going to get a pop back up. You know, based on gasoline demand, what we're seeing, it's the next number is going to likely be closer to about 8.9 to 9.1 million barrels a day. Distillate, again, had a big drop, will likely bounce back to about 3.8 on its way to where we think it's going to settle at about 4.1 million. But we're getting a lot of headwinds when we look at diesel demand. You know, shipping is coming down, trucking is continuing to slow. Again, slowly, but it's still moving in the wrong direction. So we will get some headwinds for distillate demand. And then obviously gasoline demand is going to be a problem as just pricing continues to be a bellwether. And then the headwind. And then when you look at jet fuel, again, we expect it to come right back to 1.45 million barrels a day. Propylene dropped by 32,000 barrels, but again, something small that'll, we continue to see exports remaining robust. When we look at gasoline applied demand here, you can see just the sheer size of it. It's going to bounce again. It's just going to stay very low. And as we've been saying, it's going to stay in a fairly tight band, which is going to be well below where we normally are this time of year, which is about 9.5, 9.7 million barrels a day. It's just now going to be, 9.1 million barrels a day. We were assuming 9.1 to 9.3. If this pressure holds, we may have to take that down a bit. I don't think it does. I'm still comfortable saying 9.1 million is going to be the low point. It just means that we could tighten that range and maybe we don't get that 9.3, but instead we kind of hang around on an average of 9.1, going to about 8.9, 9.2, and averaging out to that level. But it still doesn't change what we're saying. We're going to lock in a demand level just well below where we should be this time of year. Now, when we look at crude oil inventories, they continue to trend higher. Again, the trend is going to be slow. We're not getting this massive rate of change. It's just going to be a slow grind up, which is what we continue to see moving into the market and moving closer to where we were, obviously, in 2021, based on those comps getting easier. Days of supply going up just because we're continuing to get builds. So again, nothing much to say here. When we factor in crude and product, we're now back above where we were in 2018. But as we've been saying, it's going to be just that slow grind up, fairly flat, but the comps get easier because typically this period of time, you're getting drawdowns. And one of the things that we've been saying is we're not going to see drawdowns the same way. So then when we look at gasoline storage, as we were saying, we expected it to have a counter-seasonal build. We expect to continue to see counter-seasonal builds. And even if if it's flat or just slightly down, it's still going to buck the trend, which is normally we get these continuous drawdowns into essentially the last week of August, first week of September. Instead, we continue to see this being fairly flat. And then when you look at distillate storage, the rate of change remains depressed. We're not getting this big increase, which again is going to continue to support a lot of those crack spreads. Jet fuel, very balanced. Again, not much to say one way or the other because they're going to try to manage the jet pool as well as the diesel pool. And the bigger problem here is when you look at the curve, the futures curve, you can see that the whole curve has gotten a big shift down. And a lot of this pressure is coming into just the amount of the recession and a global recession. And a lot of that is being priced in where you're just not going to see that crude demand. But you can see it moves around a lot. We still see a lot of opportunity in the middle, in that belly of the curve. It's just, again, the front month was too high. We do think that there is some upside to the front of the curve at this point. But again, it's closer to just being this back and forth in terms of what that demand looks like in the near term. So then when you look at PADD 3, crude builds continue. It's the highest it's been in 2022. We're now above where we were in 2021. And obviously 2020, that yellow line is skewing the 5-year average, but we're actually above the 5-year average. Obviously, if you take out 2020, that's where we're seeing. So again, it's very normal in PADD 3. And then when you look at Cushing, as we were saying, a bit of a flatlining and just a slow grind up as we just get activity slowing a bit, but we do see production remaining a bit elevated, which will support some of those flows. While floating storage remains fairly flat, and we do expect this to trend up just given the amount of buying that has happened from the West Africa and from the Middle East, just given the heavy needs for crude. So we do expect to see more Saudi, Kuwaiti, and Iraqi crude coming into the U.S., as well as Nigerian, which will increase some of this floating storage just on those timing delays that we talked about. So that's the summary we have here. In the next segment, we're going to go deeper into refined product demand and some of the things that we see happening in the near term.